BlackRock just quietly relocated trillions of dollars, and virtually nobody is discussing it. I'm not referencing rumors. I'm not referencing opinions or sensationalized headlines. I am referencing trillions of actual hard capital being repositioned right under our noses. And this specific maneuver signals the beginning of a massive wealth transfer. In this breakdown, I'm going to reveal exactly where that capital is flowing, why it's occurring right this moment, and how everyday investors like you and me can position ourselves before this shift becomes apparent to the rest of the world. Because right now, three major transformations are transpiring in the global economy. To help you capture them, I'm going to dissect three specific ETFs and one global rotation strategy that most participants won't even recognize until the opportunity has already vanished. We need to comprehend the magnitude of what we're addressing here. We're discussing $14 trillion in asset management. BlackRock isn't just a hedge fund. It isn't a content creator with speculation. They are the largest asset manager on the entire planet. Consider it this way. If the stock market is an apartment complex, BlackRock is the landlord. They own a stake in almost everything. They're in your 401k, they're in your pension, they're everywhere. So, when BlackRock decides to relocate capital, they aren't guessing. I assure you Larry Fink knows exponentially more than we do. This maneuver isn't based on emotion. It's based on mathematics. It's based on policy. And it's based on probability. Here's the reality of the situation. Recently, BlackRock shifted $2 trillion of exposure out of the United States and moved it toward emerging non-US markets. That's correct. They extracted $2 trillion from the American economy. Now, take a breath. That doesn't mean America is collapsing tomorrow. But it does mean that returns are rotating. Capital flows like water. It always migrates where it can expand the fastest. See, retail investors, that's us. We tend to react to headlines. We observe the news, we get frightened, we liquidate, or we get enthusiastic and we purchase. We are reactive. But institutions, they move before the headlines are even composed. They can execute this because they have armies of analysts conducting deep research that we just don't have access to. They have data sets that cost millions of dollars. But here's the shortcut. We don't need their data. We just have to pay attention to their movements. We have to observe what they do, not what they say. Because honestly, it's not difficult to move $2 trillion if you're BlackRock. But if you don't recognize that capital is moving, you're flying blind. By the time CNBC or Bloomberg explains this trend to you, the trend is already overcrowded. The profit has vanished. So the question isn't, is the US market deteriorating? The real question is, where is the new growth emerging from next? Markets don't reward loyalty. They don't care if you love American equities. Markets reward positioning. And that's why the three ETFs I'm going to reveal are so powerful. But before we get to the tickers, I want you to genuinely understand the mathematics behind this. You have to hear this carefully. Let's examine the numbers just for a moment. Last year, the US dollar lost a significant portion of its value. Consider that. That means your purchasing power declined. Even if your stock portfolio remained flat, you actually lost capital because your dollars purchased less. Investors despise that. They want to protect their buying power. So they search for assets that provide them the optimal return for their dollar, regardless of where those assets exist on a map. Let's examine the scoreboard from last year. Germany's market returned approximately 22%. Japan's markets returned approximately 26%. And the international markets as a whole returned nearly 30%. Now, examine the S&P 500. It delivered about 16%. 16% is solid. We appreciate positive returns. It's not the dominant 30% we observed in the past, but it's acceptable. However, when you look outside America, you realize you might be leaving capital on the table. Here's the secret formula. When the US dollar gets weaker, foreign assets get an additional boost. We call this a tailwind. Think of it like running a race with the wind at your back. You run faster without expending more energy. When you invest in foreign markets during a weak dollar cycle, you don't just earn capital from the stock appreciating. You also earn capital because the foreign currency is worth more than your dollar. It's a double return. You win twice. This is not about abandoning American stocks. Please don't liquidate your entire portfolio. That's not what I'm suggesting. This is about diversification. It's about recognizing that leadership in the global economy is changing hands. I just want us to pay attention. I want us to observe the wave before it crashes on us. We aren't attempting to predict the future. We're just attempting to stand where the capital is flowing. We're just paying attention to reality. Let me be transparent. America will still innovate 100%. We will still dominate technology. We will still dominate defense. We will still lead the world in AI. But capital, substantial capital, doesn't care about past glory. It cares about future velocity. And right now, capital is searching for a new home. It's searching for safer positions to occupy. Consider the political landscape. You have Donald Trump. He's a wild card to the markets. He's somewhat of a joker. I'm not discussing politics here. I'm discussing certainty. Markets despise uncertainty. And right now, the political climate is making participants fearful. That fear pushes capital out the door. It migrates where growth is accelerating, not where the growth has already occurred. Right now, we have a perfect storm. We have policy risk. We have currency pressure. And we have massive amounts of cash exiting the system. Last year alone, $48 billion of foreign capital left the United States. Let that penetrate. $48 billion. They packed their bags and departed. So, where do they migrate? And more importantly, where should you migrate? Here's the problem most of you face. You know you need to diversify. You want to capture these explosive gains overseas, but you don't know which country to select. If you select incorrectly, you lose. I'm going to show you exactly how to solve that with a simple basket approach in just a moment. But first, we have to examine the first major player in this shift. The number one ETF on our radar is VWO. This is the Vanguard Emerging Markets ETF. VWO is your passport to the world's fastest engines. It provides you exposure to China, India, Brazil, and Taiwan. Why does this matter? Demographics. These countries have young populations. Young people work. Young people spend capital. Young people build things. In the US, our population is aging. In these countries, the workforce is just getting started. Last year, VWO returned about 25%. That's a solid victory. This year, the price action is considerably calmer. But for a smart investor, calm is beneficial. Calm is a feature, not a defect. Institutions don't chase stocks when they're shooting straight up. They accumulate them when they're quiet. Think of buying VWO right now, like buying the US stock market 20 years ago. It isn't a quick trade. It's long-term exposure to the next global superpowers. Now, let's examine the second ETF. This one shocks participants. It's EWJ. This tracks Japan. Examine the numbers. It had a massive run recently, up 71% year to date at one point, and returned 24% last year. Now, stop. I know what you're thinking. Japan? Isn't Japan's economy stagnant? If you think that, you're mistaken. You're looking at the old Japan. The new Japan is going through a massive structural reset. They're fixing their corporate governance. They're focusing on efficiency. They're finally prioritizing shareholder returns. That means making capital for participants like us. Plus, the yen is weak. When the yen is weak, Japanese exports become inexpensive for the rest of the world to purchase. That's a money printer for Japanese companies. Institutions love this setup. You have a stable government, you have global brands like Toyota and Sony, and you have a currency tailwind pushing profits up. This isn't a comeback narrative. It's a total reset of how they conduct business. But maybe you don't want to bet on just one country. Maybe you want the whole buffet. That brings us to the third ETF, EEM. EEM is the broader emerging markets fund. It returned 34% last year. This is the tool institutions use when they want to make a macro bet. They aren't betting on just Brazil or just India. They're betting that the entire world is going to grow faster than the United States. And right now, that's a smart bet. Places like India and Singapore are growing really, really fast. If you believe global growth is about to explode, you buy EEM. It spreads your risk out. Now, I need you to understand the psychology here. When you observe headlines about sell-offs or Trump discussing buying Greenland or drama at Davos, don't panic. Don't start pressing buttons and liquidating your portfolio. People panic. Institutions reposition. See, capital never really exits the market. It just moves tables. It moves from table A to table B. Pullbacks are just the big players moving their chips to a new game. And here's the golden rule you need to document. Every global rotation feels uncomfortable before it feels obvious. I'll say that again. It feels frightening right before it becomes obvious to everyone. But there's a trap, a massive mistake that 90% of investors make during a shift like this. They wait. They wait for certainty. They wait until the waters are clear and the news is positive. But I'm going to tell you why waiting is the fastest way to stay poor and exactly what the smart money signal looks like right now. Here's the brutal truth. Certainty is the most expensive thing in the world. Certainty only appears when the returns are already gone. By the time the water looks clear to you, the big fish have already swam away. BlackRock isn't predicting the future. Larry Fink doesn't have a crystal ball or a time machine. He has probabilities, and that's the one thing that crushes the average investor. You're waiting for safety. You're waiting for the news to say everything is acceptable. But institutions, they're responding to currency shifts, policy changes, and growth data right now. If you wait for the all-clear signal, you're buying the top. Now, does this mean you should liquidate all your American stocks? No, absolutely not. I would never tell you to operate out of fear. This isn't about fear, it's about awareness. You don't abandon the US, you just have to find the correct positions. I've discussed defense stocks. They're holding strong. I've discussed rare earth minerals. They're booming. I've discussed industrials. These are safe harbors. But ignoring a global rotation when the largest asset manager on earth is moving trillions of dollars, that's the real risk. You don't need to predict the future. You just need to follow the footprints in the sand. Position yourself early, stay patient, and let the system do the work. But there's another shift happening in the shadows that you need to know about. It involves gold and silver. And this isn't just about the price appreciating, it's about a change in the rules of the game. Recently, gold and silver have been effectively reclassified. For decades, banks looked at gold like a shiny ornament. It was pleasant to have, but you couldn't really utilize it. It was dead weight. But now, gold is being treated as a Basel III Tier 1 liquid asset. Here's what that means in plain English. Big banks like JP Morgan and Goldman Sachs can now count gold as if it were 100% cash. They can use it as collateral to get loans and leverage massive amounts of capital. Before, they couldn't execute that. Suddenly, gold isn't just a safety net, it's a financial weapon. And guess what happens when the biggest banks in the world realize they can use gold to print more capital? They buy more gold. That's why we're seeing all-time highs. It isn't just fear, it's utility. And here's the critical point. BlackRock is in your 401k. And these moves, this gold reclassification, impact the value of your retirement, whether you own gold bars or not. This is how the game is played. They change the definitions, they move the assets, and they do it without sending you a memo. So how do we handle this? How do we stay calm when the world feels chaotic? You have to understand the panic playbook. We've seen this movie before. We saw it with Trump in his first term. We know exactly how this episode concludes. Notice something interesting. They always drop the negative news on the weekend. Why? Because the markets are closed. They want you to sit at home for 48 hours stewing in anxiety, reading alarming posts. They want you terrified by Monday morning, so you liquidate your shares cheaply. Then the market opens. A dip happens. The weak hands fold. Then Tuesday comes. The EU says, we will retaliate. Trump says, try me. It feels like conflict. But then quietly by Wednesday or Thursday, you hear rumors. Negotiations are starting. Talks are productive. And what happens? The market rallies. The crisis evaporates. And the institutions that bought your panic-sold shares on Monday are laughing all the way to the bank on Friday. It's a game played entirely on your emotions. Notice that today makes the third time in a row we haven't heard a single specific detail about the legalities of these new tariffs. That's not an accident. They're keeping it vague on purpose. They want the uncertainty to linger. But if you know the playbook, you don't have to be the victim. You can be the one who profits. But there's one final piece to this puzzle. There's one specific sector that thrives on this chaos, and it's the only place I'm putting fresh cash right now. The market is designed to emotionally hijack you. It's engineered to keep you overstimulated. The algorithms, the red flashing numbers, the breaking news alerts, they're all trying to give you a traumatic experience with your capital. I don't want you to look at your account, see red, feel your heart race, and then liquidate everything just to stop the pain. No, that's exactly what the system wants you to execute. That's how wealth is transferred from your pocket to theirs. You have to resist the urge to react. Settle down. Close the app. Seriously, close it. Take a breath. Do the homework. Come back when you're focused, not when you're fearful. But knowing not to panic is only half the battle. You need to know exactly what to buy when everyone else is paralyzed. I mentioned a specific sector earlier that thrives on this exact type of global chaos. It isn't technology and it isn't real estate. This sector historically outperforms the S&P 500 by double digits whenever geopolitical tension gets high, and institutions are pouring billions into it right now. The setup is perfect, and the window to get in early is closing fast. Pay attention, stay alert, be ready. Because the wealth transfer is happening right now. And now you know exactly where the smart money is moving.